I mean, we had the Fed, we hear the government. I mean, they're all telling us how great it is. I mean, they just revised the numbers, the second quarter GDP numbers, and they pushed it up to 3.9%. They're telling us unemployment is down at 5.1%. And Yellen says the economy is solid. We're good to go. I mean, do you agree with her?
Well, you have to look at how the numbers are being produced now, don't you? See, here's the little ugly bit that nobody wants to discuss. We measure GDP in dollars. Okay, well, there's an assumption here, and that is that the number of dollars per person in the country, that is the denominator, is a constant. And if it's not, then basic algebra says that you have to remove that differential factor from both sides of the equation, right? I mean, this is, you learn this your first year of algebra in high school. And so if you just use the numbers as given, yeah, I mean, they are what they are. However, I produce a report every quarter off of the Fed Z1, which is the canonical definition of all flows of funds in the U.S. economy. And since our money is issued as debt, this is the way to determine how much of our money is in circulation, because a $20 bill and $20 of available credit on your Visa card spends exactly the same way. So when you look at that, what you find is that we've been running approximately 5-6% monetary inflation for the last few years. And during the go-go bubble years, it was closer to 20 to 25%. It was a couple-year period where it was actually almost 25%. So if you were to norm that back out, and you have to, accommodating for both the change in population, we grow population about 1% a year, and also the growth in wages, because of course if your paycheck goes up, then you don't care that prices go up, right? As long as your wages go up just as fast. Then what you'd find is that we're actually running slightly under or right at par since 2009. In other words, there's been no economic growth at all. This, by the way, is reflected in the population employment ratio, which is the percentage of people that are age 16 and over who are actually working. It has not recovered, and the reason it has not recovered is that it's not there. Okay, when you look at the economic figures, adjusting back out for monetary growth. And so what's really happened, and again, if you look at the statistics, the other statistics, which is average earnings, household average earnings, you'll find that in inflation-adjusted figures, even trusting the government's inflation numbers, the average household is making about as much as it was in the 1980s. So there hasn't been any improvement in standard of living. What we've done is compensated for this by issuing more and more debt, and where that debt has largely gone to prevent this from being realized in the economy is in various forms of entitlement programs. So this is why you have this sort of deficits that we're running. But the real 900-pound gorilla in the room isn't in the monetary issuance that's already happened. It's in the forward promises that we've made to people, especially in the medical field, with regards to Medicare. And so when you look at the economy on a factual basis, using arithmetic as your foundation, because the math is truth, what you find is there hasn't been any recovery at all. And we've just essentially bought off the American public.
So right now, I mean, the Fed keeps saying, and they keep telling us that the economy is getting stronger, like I said, and you're telling us that no, the economy is not getting stronger, and the Fed is wavering between, these interest rate hikes. Oh, we're going to raise them. And I think they told us, 55 times now that they're going to do this. And then all of a sudden we hear negative interest rates seeping into the conversation across the corporate media and coming out of the Fed. So what's stopping them from raising these interest rates?
A number of things. But you have to understand that there's also pressure on the other side too. Mm-hmm. Okay. The countervailing pressures come from two different opposing forces, if you will. There are trillions of dollars of forward liabilities, numbering in the tens of trillions, just in the private sector alone, in the form of pension obligations. There are trillions more in forward obligations found in insurance companies. Now, this is leaving the government obligations out of it, the Medicare and the Social Security side of things. So we'll just deal with the private economy because it's a little easier to get your arms around. All of these organizations, whether they be pension funds or insurance companies, are in the bond market, and they use bond laddering in order to match the duration of their obligations to the duration of their investments. This is something that they're required to do by law, and it's the only smart thing to do. Even if there wasn't a law that required it, they'd have to do it, because otherwise one bad market crash and you'd instantly go bankrupt and everybody would lose everything that was vested in these things. So what happens is, if you have, say, for example, a 20-year expected duration of payout, the pension fund, you build a bond ladder that has a maturity, an average maturity of 20 years, and 1/20th, roughly, of those bonds roll off every year and get replaced. Well, when you run zero interest rates and you suppress rates across the curve, what happens is 1/20th of those bonds that get replaced with very low yielding bonds. Okay? So the damage starts out very small. The first year, this pension fund, instead of having a 5% interest rate on its entire portfolio, has 5% on 19 of 20 of its bonds, and on the 20th it has 1%. Well, that's a pretty bad hit, but it's tiny. It's 1/20th of its total portfolio. But every year that goes on, the damage gets worse. Pretty soon, you have bond managers in these pension funds and these insurance companies calling up people at the Federal Reserve and saying, excuse me, we are not going to be able to make the payments to these retirees and to these insurance beneficiaries 5 years out unless you cut this crap out right now. All right, now, here's the really ugly news. If the Fed was to stop today and normalize rates, in other words, withdraw all the accommodation, go back to about a 5% short-term interest rate, which is roughly where it ought to be, it would take the same number of years that it took to accumulate the damage for it to go away. For the same reason, okay? Because you only put a 20th of them back on every year. And oh, by the way, if you tried to sell out of those bonds and then rebuy them, you just crystallize the loss. So the loss that you've taken by buying these instruments cannot be gotten rid of. It has to be flushed through the system. It's the python that eats the pig. It takes time for him to digest that pig. And then we know what comes out the other end eventually. But until that pig gets digested, it's stuck there. It's not going anywhere. And so you've got the same problem. Now, this is the pressure on the Fed to raise rates, okay, to withdraw its accommodation. On the other side, you have both the government and private enterprises that have borrowed enormous amounts of money without any intention to ever pay it off. And the way this scam works is what has driven the equity markets and the so-called miracle on Wall Street over the last 30 years. And that is this. Let's say I have a 10% interest rate in the economy. I borrow $1 million and I have to have $100,000 a year to service that debt every year that I have to generate from running my company. So this year I must have $100,000. Okay, I pay that. Next year I must have $100,000. And when that bond becomes due, I can roll it over. I don't have to pay it off. As long as I have the $100,000 every year, everything's fine.
Right.
Now rates go down from 10% to 1% over the course of a 30-year period. And instead of borrowing $1 million, I can borrow $10 million. Mm-hmm. And I do so still spending the same $100,000 to carry it. The difference is I don't put the $10 million into building a new plant to make more cars or computers or robots or whatever. I spend it. It's gone. This happens within the government as well. I spend it on food stamps and on Medicaid and on all kinds of other wonderful social programs that both Democrats and Republicans love to fund. Now, what happens when the rate of interest goes up?
Right.
If it goes from 1% to 2%, I need $200,000. Well, what if I don't have $200,000? All right. So this is the pressure on the Fed to not raise rates because, and in the private sector, this is especially profound because you have all of these companies out there that claim to be in great financial shape. You hear this all the time in the financial media. Cash on balance sheets is at all-time highs, da-da-da-da-da. Okay, guys, get out the Fed Z1 and look at non-financial corporate debt. It's also at all-time highs. It never went down during the crash. I believe there was one quarter that it actually decreased by a small amount. There may have been two. but it was an infinitesimally decrease, and now it is again at all-time highs, and it's been growing very strongly. So all that cash is a chimera because there is debt on the other side of the balance sheet that, of course, balances that out. And as long as it's extremely cheap for you to continue to carry that, this looks okay. But as soon as the cost of carrying that debt goes up, what happens to your earnings? All right, so what you've seen here is a tremendous rise in the stock market that over the last 30 years has been fueled by the accumulation of leverage in the economy. It has not been fueled by making more products. We keep hearing that earnings are at all-time highs, but if I'm buying back stock with borrowed money, I can make the earnings look like whatever I want them to, right up until the point that I can't afford to carry the debt anymore. So this is the pressure on the other side of the Fed to not raise rates. Unfortunately, ultimately, the Fed gets in a situation where they're actually led by the market. There is a widely held belief that the Federal Reserve controls interest rates. They only do so at the very short end of the curve for nearly riskless transactions. Mm-hmm. If you look at the actual data, you will find that between even in the Treasury market, between the Treasury market and the Fed funds rate, 90% of the time the market moves first and the Fed follows them. And the reason the Fed follows them is that trying to fight the market is a losing battle. There is more money in the market than there is in the Fed. And so while the Fed cannot technically go bankrupt, it can functionally go bankrupt. And they know this. So as that pressure builds on them, they're forced to follow along with what the market wants to do. And that's going to happen again.
So do you think they'll ever raise interest rates?
Oh, they're going to have to raise interest rates, and they're being pressured into doing it right now. If you look at what's going on today, especially in the higher yield areas, and the energy sector is where this is showing up first. There is an absolute disaster going on right now among energy companies. And this is spreading. It started in one small area and it's starting to spread out. This sort of financial stress ultimately forces the Federal Reserve off the dime. They're going to have to raise rates in order to take that liquidity out of the system because there isn't any way that they can continue to fight that on an indefinite forward basis. It's not possible.
So if they raise interest rates, what happens to the rest of the economy, like housing, auto loans, and everything else? I mean, what is going to happen at that point? Because we saw what happened in 2008 when rates started to go up.
Well, see, this is one of the things that it depends on who you are. Okay, let's look at this from a real economy perspective, and then from a government and big corporation perspective. Okay. All right. From a real economy perspective, if you're a really good credit today, you're probably still paying 10% on your credit card, right? All right. So your credit card rate goes from 10% to 10.25%. Do you care?
Not really.
Not really, right? It's 0.25%. It's nothing because you started at 10, right? It's percentage-wise, it's a very small move. If your mortgage goes from 4% to 4.25%, that probably doesn't change your life either. Yes, it's money out of your pocket, but it probably doesn't cause a huge dislocation. Now, if mortgage rates go up by 300 or 400 basis points, so it's 3 or 4%, that's a different thing entirely. But we're talking about 0.25% here now. All right, now look at the company that borrowed money at 0.5%, or the government that borrowed money at 0.5%, and it goes up by 25 basis points. If you're the government, your borrowing costs just went up by 50%. That's a big problem. All right. So the impact that it has depends on where you sit in the economic strata. For the large corporations that have been the beneficiaries of this, and the very wealthy people at the top of them, along with governments that have been the beneficiaries of this, the impact is going to be severe. For the average consumer on the street, not at all.
Okay, so they can do this with not affecting the everyday person and say, look, see, we raised the interest rates, we're still on recovery, and see, everything is fine. And
except that they may crash the stock market.
Well, yeah, that's. I mean, for the everyday person on the street, they'll say, oh yeah, look, nothing really happened to me. And then if we look at companies right now, we see like HP, UniCredit, Deutsche. I mean, they're all starting these mass layoffs. and they're getting rid of all these people.
Well, it's
And
because they can't make any money. But then you take a look at these unicorns that are out there in the marketplace with valuations of 1,000 times earnings, companies like Amazon, Facebook,
mm,
things like this, and their so-called price in the marketplace is entirely a function of all of this liquidity that's floating around in this view that they're going to be able to access capital markets along with the people that are buying the stock uh, on a permanent forward basis at 0.25%. Well, that's not going to be true anymore. The carrying costs are going to go up dramatically. See, you as an investor, if you trade on margin, you're not getting those kinds of rates, okay, on your margin loan. Your margin loan, if you're trading on margin, is probably being priced in 5-6% area. So if it goes up 0.25% for you, it's not going to matter much. But for the big banking houses, the big institutions that are essentially trading at or near Fed funds, it's going to have an enormous impact.
okay, so I mean, right now we're seeing the stock market. I mean, it's really fluctuating. I mean, since August, it's been it's been going down, it's been pumped back up, it goes down, and we see this in Asia, we see this in Europe. What's going on in the markets? Why so much volatility?
Because the 30-year trend that has driven leverage accumulation, which has been the generally falling rate of interest in the markets since the 1980s, when Volcker was essentially forced to do what he did in order to prevent a wage price spiral that was completely out of control. And by the way, that wasn't his fault. He was forced into that by what Nixon had done previously with his wage and price controls. So, again, the Fed got led by the market, not the other way around. When you look at what's going on here, what you're seeing is the market starting to look at the end of a secular trend. Most of the people that are in the market today, that are running these investment houses, that are making these decisions, and that are the advisors that are talking to you when you call them, they have never seen a market that isn't dominated by a secular trend lower in borrowing costs. That's the entire world they've known for their entire life in the business. They've never seen it the other way around. But now that trend, simply because zero is a hard lower boundary, has come to an end. Even if rates don't lift, it's still come to an end. And as evidence for this, I think people ought to pay attention to what happened in Japan. Japan hit their zero boundary a couple decades before we did. Remember, folks, the Nikkei was over 40,000 the time that they hit their zero boundary. It is trading well off that and has never gone anywhere near it again. So the idea that we are not going to have the same sort of leverage contraction come out of our economy, even if rates don't go materially higher than where they are now, I think is more than a little naive.
Okay, so let me ask you this. Where do you think this economy, the U.S. economy, the world economy, because the IMF is continually coming out saying, okay, the global economy, we're going to have to downgrade it once again. Where do you think the economy is going at this point?
Well, I think the economy has gone absolutely nowhere for the last 7 or 8 years. I believe mathematically that's easily documented and proved. I don't think it's going anywhere in the positive sense until we clear this excess debt that is leverage out of the system. That's not going to happen voluntarily, by the way, because to do that would be to admit that all of these policies have been failures, and the people who promulgated them and caused them to be put into place, the American people, not to mention the people of the world, would want pikes on, heads on pikes. And they'd probably get them at some point. I mean, maybe not here in the U.S., but somewhere around the world, someone would get the wild idea that, bankers and lampposts go well together. So I don't see that happening voluntarily, but at the point that you can't pay, and it doesn't matter what you try to move around. We got out of this last mess in 2009, almost to the day when Congress, a congressional session, a committee hearing, called FASB into their offices and told them that they were going to permit banks to carry assets on their balance sheet at whatever value they made up. And if they didn't allow that, if they didn't change the accounting standards, that Congress was going to legislate that into being. It was almost to the day that the market bottomed at 666. I mean, literally to the day. All right. Now, who came in buying massive quantities of stocks knowing that this meeting happened? Well, all the banks that no longer had to worry about being exposed as being insolvent, right? I mean, this is
Right.
just logic. This is, and is that illegal? Not really, because that hearing wasn't private. But did we actually fix anything by allowing people to lie about their balance sheets? Well, of course not. So we transferred this leverage from one place to another. We took it off the bank balance sheets, and you can see this in the Fed Z1, and we put most of it on the federal government's balance sheet. The rest of it got added on to private institutions' balance sheets over time as they used the same environment to buy back stock and leverage themselves up. Okay, now you're still at the end of the cycle. So how do you generate growth for real, because you can't do it by lying anymore? And what happens to the markets when people come to realize that this growth isn't happening, whether you're making it up or not? You can't produce these earnings beats because there isn't anything to produce them with. The financial engineering games don't work anymore because you don't have this environment.
So do you think we're going to have a meltdown like we did in 2008?
Um, it's certainly possible, but my guess is that the more likely scenario is more of a grind down than a meltdown. The danger is that you have leverage buildup in places where it's hidden, just like it was the last time. Where I would be concerned about it is in energy production, distribution, speculation, storage, and things like this. Glencore comes to mind.
It's just in the news today, yes.
Yeah, but is that systemic? I don't know. Who holds their CDS? The issue is never the known things. It's the interconnections between people that aren't being talked about. The more likely scenario, though, is that over the next couple of years, as rates are unable to be depressed any further, and the ability to actually drive valuations through things like QE in Europe ends. And remember, our Fed, I said this before Bernanke stopped. I said he's going to stop QE, even though I was pretty much the only one saying it. And I pointed out why. It had to do with the pension funds and the insurance industry. As they are forced to stop this over in Europe as well, and as China's so-called growth miracle is exposed as being just nothing other than debt accumulation, you're going to see expectations ratcheted back down. How much of what is in the market today is speculative premium based upon a false premise? I think it's easy to make the case that half of the current price is there. And so, I think you're going to see a major reset in market values. But I think the more likely scenario than a crash, which comes from hidden risk, I mean that's always where it comes from, is the grind lower as these expectations get reset. And that's even more dangerous for the average person, because you get your account statement and you're down 10%, and you say, well, it's probably about over. And the next month it's down another 10, and then it's down another 10. Pretty soon you've lost half your money. And the problem is you don't get scared out, okay? Because the big dramatic drop never happens. It just kind of grinds lower. And that's what we've seen here over the last couple of months. I mean, there's been a couple of kind of scary drops, but for the most part, what we've got is just this kind of grind lower, secular sort of, oh, this ain't so good kind of thing. When you go back and you look at where we are today, we're not really very far off from where we were last October. That was a year ago. All right, so we've round tripped, and the thing is that we're still from a market perspective, everybody's saying, oh, it's just a correction in a bull market. Well, technically, it doesn't look like one. And the problem is what drove that bull market, and what drove it was accumulation of leverage and share buybacks and cheap debt. And that era is over.
So do you see any black swans? Do you see anything, out there that might just all of a sudden just have a domino effect? I mean, you hear Deutsche, you hear Glencore. I mean, you hear all these different things occurring. Do you see anything?
Well, by definition, a black swan is one that you don't recognize until it lands on your yard, right?
And I'm telling you to look into the crystal ball and try
I
to.
mean, my view of it is that the big risks are always the ones that nobody sees coming are leverage based, hidden leverage, and geopolitical. Those are the two places where it, where historically has always come from. I mean, the big one in the 1970s, early 80s was of course the Arab oil embargo, right? That was geopolitical risk. Um, the big issue in 2006, 2007 was all of the crazy hidden derivatives and BS that was written against worthless mortgages, which by the way were all frauds, and yet nobody went to jail for any of them. What we've got going on now is what appears to be blatantly obvious leverage taken on by corporations and government entities in the form of both handouts and buybacks in the case of governments and corporations respectively. But the danger is that you have a derivative chain behind a Glencore or a Deutsche Bank that goes into places that people haven't anticipated. And one of the things that we know happened after Dodd-Frank was passed is that the banks offshored their derivative exposure to other nations in order to avoid the regulations in the United States. So we have these so-called multinational institutions that have, very adept at gaming the system. They did it last time, and they certainly haven't stopped. And so the real question is, what is your real capital ratio when you look at all of the derivative exposure that you have? And it's very hard to figure out because the big one that everyone likes in the doomsayer camp likes to point at is this crazy notional value for derivatives that's out in the marketplace. And the number's true, but it's highly misleading because currency derivatives are the bulk of that. And currency derivatives only have a notional exposure if the currency in question goes to zero. In other words, if the euro ceases to exist and becomes completely worthless, then that becomes fully realized risk. But the odds of that happening is essentially nil. All right. So for example, if I have a derivative exposure against the Japanese yen versus the dollar, the only way that the notional value of that derivative becomes the actual cost is if Japan ceases to exist and the yen becomes worth nothing. Mm-hmm. Now, that's not going to, or if the dollar does, that's not going to happen. So that's a misleading way of looking at it. But what's not misleading is the derivatives that are written against other instruments because companies do go bankrupt.
So, I mean, we hear things about Deutsche Bank right now with their derivative exposure. There's an investigation going on with Deutsche Bank. Do you see anything happening with them at all?
I have said for a long time, going all the way back to the time of the crisis, that I don't like the accounting in the balance sheets of U.S. banks because they're very hard to read. Mm-hmm. It is utterly impossible for me to get my arms around the exposure in the foreign banks. I just simply can't believe. I mean, there's too much that's not in the paperwork that makes it impossible for me to judge what their exposure really is. And so I can't evaluate that because, and now there is, however, something to keep in mind, and that is I've never seen anybody hide good news. Okay, so this is something to keep in the back of your head, is that anytime that someone has good news, they always get up on the top of the soapbox and scream, right?
That's true.
So if I'm not telling you about something, it's probably because it's not so good.
How do you think this whole is going to play out? We're just going to continue on the way we are?
No, I think you're going to see a massive reset lower in valuations. Those people who are over-levered that escaped paying for it in the 2008 timeframe are going to find out that their luck has run out. The people who got rammed in 2008 and 2009, for the most part, were individual consumers, people who had bought houses they couldn't afford, for example. The institutions and other operating companies that did the same sort of thing got bailed out and got away with it. Now that is beyond the banks and it's into mainstream corporate America. Those people are not going to get bailed out. And so I think you have to be very aware of the fact that we have kind of a cost driving mentality right now in corporate America They're scrambling to try to prevent this from biting them by offshoring as much labor as they can. You look at what's going on with Hewlett Packard, for example, along with other companies. The people that run these firms, they see the writing on the wall. They know that the behavior that they've engaged in, at least any CFO that has a brain, knows that this game is going to come to an end. It has to. And so they're scrambling to find some way to keep up the appearances, because I believe most of these firms know that half or more of their stock price is essentially hot air. And remember, most of these executives are paid in either restricted stock units or options.
And how about the everyday person on the street? What are they going to, I mean, from going forward from this point on, is it just this is the way it's going to be for them?
Unless we get somebody in the White House and a Congress. See, it can't just be a president; it has to be a Congress too. We need to throw not just the person in the White House out. We need to throw 90% of the Congress out too. In order for us to have a productive change in our economic future, we have to put a stop to the offshoring of labor in this country and bring it back here. That is, we have to make it unproductive financially for companies to do what they've done. Because what we have right now is a labor market that has gone from a manufacturing and high-paying service economy to one that is essentially comprised of people pulling coffees at Starbucks.
Right.
All right, that is not a living wage, and it cannot be turned into one. And oh, by the way, the high-wage jobs that are left are, to a large degree, they were in places like computer programming. Now those are going offshore.
Yeah.
They were in healthcare. Now those are going offshore. And so what you have is a bunch of low-paid coders that are doing medical coding. You got a handful of physicians that are coming out of medical school with $250,000 worth of debt. Okay, their actual take-home pay after servicing that debt is looks like that of a plumber, right? And the only people that are left that are able to do something that's productive in today's world, if I was giving advice to young people, I'd say learn a trade, something that can't be offshored. Because if my drain is stopped up, I need it fixed now, and you can't send that to China. Okay, but we have to put a stop to this as a policy. The problem is that to do that, we have to stop the deficit spending in Washington, because the two are intertwined. The reason we're able to get away with this at a corporate level and at a government level is because we run these deficits. That's the reason these distortions exist. It's the reason the Federal Reserve has done what it's done. It all begins and ends with spending $1 trillion a year that we don't have. And that must end. The only way to address this in the U.S. budget, if we're ever going to get serious about this, is we have to break the medical monopolies. If we were to do that, we would see the price of medical care in this country collapse by 50 to 80%. That would wipe out the federal budget deficit instantly. Okay? That means no more dedication